Hi there, I'm Dean Orrico, lead portfolio manager for our real estate strategies here at Middlefield. And I'm here to give you an update on our 2024 outlook for real estate and how our funds are positioned right now to take advantage of what we think is going to be a great opportunity in the public REIT area for 2024 and beyond. For those of you maybe less familiar with Middlefield, we've been involved in the real estate sector now for over 40 years, really since our founding. I've been very involved in the REIT area in Canada really since I joined Middlefield in the mid-1990s. I've gotten to know the management teams in our portfolio extremely well. I was here really when a number of them IPO'd in the Canadian market when the REIT sector really started to develop in that 1995, 96, 97 time period. So suffice to say, this is a sector that is very familiar to us and is where we have core expertise. We currently manage two dedicated real estate strategies that are actively managed, where we have high conviction in the 30 to 35 names that we own. We've got a real estate mutual fund and effectively an identical product in an ETF format that's called the Real Estate Dividend ETF. Both are very successful award-winning funds. We've won Lipper Awards for the top real estate fund in Canada in 21 and 22. We were just awarded the Fund Grade A+ award for 2023. So acknowledging that our strategy and our methodology in managing these portfolios has proven to be successful over time. This slide just basically shows you the returns we've been able to generate on our real estate mutual fund, which has been in existence for well over 10 years. As you can see, in 2023, we generated a total return of about 8.5%, relative to about 2% for our benchmark here in Canada. So we've been able to generate some good outperformance, 10-year track record of 7.5 to 8% total return. So this is a track record we're proud of, and it really is a testament to our methodology and our intimate knowledge of the sector. So let's turn to our thoughts on the real estate market currently, and then we'll give you a sense for how our portfolio of public REITs is positioned currently. Let's really start with the market backdrop. So from an economic standpoint and a fundamental standpoint, we really do think the real estate sector, and in particular, the public REIT sector, is in very good shape, extremely well positioned to generate strong returns in 2024. I look at real estate generally as a supply-demand picture from a fundamental perspective, and aside from the office sector, which has some unique challenges, we think the real estate sector generally, commercial real estate sector generally, is really benefiting from strong demand and constrained supply. Inflation is finally now under control, and as a result, you've seen a pullback in interest rates, which is also very supportive for the sector. And more recently, and I'll touch on this in a few minutes, you're finally starting to see some M&A activity in the sector. And I think that is also very supportive of valuations and results in capital recycling that we think is very healthy for the sector, the public REIT sector in particular. You still have some headwinds that we're facing, specifically in areas like the office market, which is really beset by a reduction in demand and an increase in supply over the last few years. Interest rates still remain higher than what we had in that period from 2010 to 2020 when rates were effectively zero. We don't think we're going back to that, but we do believe that rates will be coming back down as 2024 continues to move on here. So all that together with the fact that we still think public REITs, especially the ones that we own, are still trading at a discount to NAV. What you see on this slide is the whole sector is trading at a 20-25% discount to NAV. The names that we own are trading closer to about a 15% discount to NAV, whereas they would normally be trading at a premium to NAV. So we still think there's plenty of runway here for REIT prices to continue to move higher, especially in that portfolio of 30 to 35 names that we own in our Middlefield strategies. The other factor that really is affecting public REITs has been investors generally staying on the sidelines, whether they were purchasing cash or near cash alternatives in 2023, and basically parking capital there, or whether they're institutional investors who were looking at the debt markets and higher debt costs and basically staying on the sidelines. Both of those factors are now starting to turn around and becoming more tailwinds as opposed to being headwinds for the better part of the last 18 months. Our view is that there's been a massive outflow out of public REITs globally throughout 22 and 23 as interest rates went higher. You started to see inflows late last year as interest rates started coming down, and we think that's going to continue. Case in point, you saw two major institutional transactions in Canada. You saw TPG, a very large private equity firm, put up about $1 billion to purchase a 75% interest in industrial properties in the Greater Toronto area. And more recently, Blackstone announced the 100% acquisition of Tricon Residential, which is a single-family player with some multifamily developments. Again, a testament to the value that Tricon acquisition or announced acquisition by Blackstone was done at about a 30% premium to the previous trading price. So again, further validation and capital recycling we think is very healthy for the sector. We think this is a really good time to start investing in the public REIT area and in diversified portfolios of public REITs like we have here at Middlefield. As I mentioned, the fundamentals are as good as we've seen them in a long time, especially across areas like retail, multifamily, industrial, and even in senior living. We think those fundamentals continue to be very, very good. And in fact, when you look at the fundamentals together with the fact that rates are now coming down, we think that's really spurring more interest in these strategies because we believe that investors will be coming off the sidelines where they were earning 5 or 6% relatively risk-free yield in a cash-like instrument, now saying, I can no longer get that as rates are coming down, and coming into areas like REITs, which we believe are among the best equity income vehicles in the market. So we think that's really spurring significant demand. The other point I would make is that even if rates stay relatively flat, historically REITs have done very well even in that environment because major investors or investors looking at real estate have a level of comfort that rates are no longer going higher. So that level of comfort is still becoming a great incentive to put money to work in the public REIT area. From a geographical perspective, we continue to think the fundamentals, supply and demand fundamentals in Canada remain very strong. Again, you've got relatively low interest rates. You've got continued strong demand, whether that be in industrial, whether that be in multifamily, whether that be in senior living. All of those are doing very well. And in retail, we've got a tenant mix in retail in the Canadian REITs that's as good as we've seen it in over 10 years. Case in point, about a year ago, you had Bed Bath & Beyond declare bankruptcy, about 65 locations in the retail REITs here in Canada, all of which were released at higher rates on average than the leasing rates paid by Bed Bath & Beyond. So it just shows you the demand for these properties and how well positioned they are. In the US, some more challenges. You've got, relative to Canada, some higher supply coming on in areas like multifamily, making that sector a bit more challenged. But where we like the US market right now is in areas where we can't get exposure in Canada. And specifically, I'm referring to the data centers and the cell towers. We think those are continue to be very well positioned, and that's where we've got some exposure in our portfolios. Outside of North America, there are some select REITs within the UK and Europe where we have exposure right now that are either in the industrial or multifamily area, and we think that is also a positive area to get some exposure that we really can't get in the Canadian market, given some of the nuances that we're seeing in the UK and Europe. But that's a relatively small percentage, i.e. about 5% of our portfolio currently. Major nexus in the Canadian market where we continue to see strong fundamentals throughout 2024. So what's driving some of this growth in Canada? I already alluded to this to a certain extent. We've got increasing immigration levels, about 500,000 per annum permanent residents last year. Federal government continues to think that's going to happen over the next 2 to 3 years. That not only has a positive impact on the multifamily sector, the apartment sector, but it also has a positive impact on retail because more people coming into the country, a lot of in-person retail in addition to e-commerce retail happening. So that benefits both the retail REITs as well as the industrial REITs. We know most people coming to Canada go into major centers. About 50% of our population is in the 6 largest cities in Canada. And as immigrants come in, they tend to migrate to some of those larger cities as well. So creating more demand for apartments and retail in those types of markets. And that's certainly being recognized by a number of major investors like a Blackstone or a TPG, where they're making significant investments in some of those major centers. So in our view, we think there's some really attractive fundamentals supporting the areas that we're favoring, whether it be industrial REITs, where we've seen rents over the last 10 years go from about $5 a foot to about $20 a foot. Rental growth is now plateauing, which we think is very normal, but we're seeing some of our industrial REITs renewing leases going from $7 or $8 a foot to about $15 or $16 a foot, i.e. 100% increases in leases that are being renewed in this kind of market in 2024. That's benefiting certainly from the growth in e-commerce activity, which gradually continues to grow. Onshoring of supply chains is also benefiting the industrial REITs. Our retail REIT exposure is really based on necessity retail, grocery anchored retail, which again is very well positioned. Their tenants, virtually all of them are looking for more space. There have been very few new open air retail centers developed in the last 5 years. So you've got constraints on supply, you've got growing demand, hence rents continue to be in very good shape, and our retail REITs are trading at significant discounts to NAV. So we think there's really good upside there. On the apartment REITs, again, we think that's a great sector to be invested because we think the demand for housing continues to remain strong. Canada has amongst the lowest housing per capita of any country in the G7. So that supply-demand imbalance continues to drive rents higher. So we really like the outlook for the apartment REITs. The federal government is now trying to incentivize more supply because they recognize we are challenged in terms of bringing new supply to the market, and it'll take years before you get to the point where supply is able to meet the amount of demand for housing in Canada. So we think that bodes well for the apartment REITs. And as I mentioned earlier, the area that's more challenged is the office sector. You've got about 18% vacancy in the largest market being the GTA, more supply coming on, people gradually coming back to the office, and you've got a real bifurcation underway in the Canadian market where high quality office properties that are newer and offer great amenities tend to be 90% plus occupied. Office buildings that are 40 and 50 years old are sub 50% occupied, and over time will have to be repurposed. That will take a long time to happen. So at the end of the day, we think this bifurcation will continue for a number of years here, really making the office market more challenged, and sentiment there understandably continues to be quite low. So looking at the portfolio mix, just given our very constructive outlook on multifamily, retail, industrial, not surprising, those are among the highest weightings in our portfolio. In fact, over the last several weeks, we've been increasing our weighting on retail REITs. They lagged in performance in 2023. We think they're really well positioned to do well in 2024. So we've been increasing our weighting to the largest retail REITs there. Industrial, we think the fundamentals continue to be good, even though rental growth is slowing. Healthcare is a sector that we really like, really starting to come out of the challenges they experienced during the pandemic. You're seeing occupancy tick higher. You're seeing costs come down, especially those elevated costs that they incurred to deal with all the challenges due to COVID are now starting to become more normalized. So we think that's going to really have a positive impact on the bottom line. We own some really unique plays in the service sector of real estate. Companies like First Service and Colliers have been core holdings in our portfolio, and we still like the outlook for those businesses. And then outside of the more traditional sectors, as I alluded earlier, we have exposure to sectors like cell towers, which we think will continue to benefit from the growth in data and mobile traffic, data centers, which again, we think are really well positioned. And we own what we believe to be the best in class players, companies like Equinix in those areas that we think are very well positioned. So that really does cover our outlook and our very constructive view on real estate, and in particular public REITs in 2024. And then our strategies, as I've mentioned, they're all actively managed. I describe them as high conviction portfolios. We have intimate knowledge of all of our portfolio companies and know these management teams and have known them for decades. Public REITs continue to be very well managed with relatively well staggered debt maturities, relatively low debt. So we think that continues to insulate them against volatility in interest rates that you've seen over the last little while. And bottom line is that you've got strong demand and constraints on new supply, which generally speaking is good for owners of real estate. Thank you very much.